Hey everybody, it's Norris. It is our 300th episode. Yes, we've been producing for almost 6 years. Thank you for watching. If you are on Facebook, please subscribe to our channel. We're so close to getting close to 500 subscribers. If you're on Facebook, like our page. And even if you're on iTunes, if you like our radio show, please consider leaving a review, liking our pages. That would be awesome and appreciated if you like our content. Well, it's April 15th, it's tax day, and let's chat about those boomers. What are they going to do during retirement? That and much more as we cover this week's biggest headlines in real estate. Up on the radio show this week, we've got Jim Brown with Keller Williams Corona, a fairly large office, sharing information about how much turnover they have, how many agents actually make a living being a realtor, and much more a little bit from the realtor side of the conversation. Freddie Mac reported mortgage rates are at their 3-year low with 30-year rates at 3.58 and 15-year rates at 2.86. New home purchase application increased 17% month over month according to the Mortgage Bankers Association. The MBA also reported the amount of closed loans on commercial and multifamily properties was a record $508.3 billion. The amount of mortgage credit available decreased 0.2% last month to 123.5. However, the fourth quarter to now it actually increased 5.6%. So things are looking up a little. Just when you think there couldn't possibly be more fines levied against banks, 2 banks got hammered this week with new billion-dollar fines. Wells Fargo got nailed with a $1.2 billion fine, the largest in FHA history, for bad loans. And actually, this wasn't a new fine. Details of the Goldman Sachs $5 billion settlement with the Department of Justice was released this week. The feds will take some $2.3 billion for themselves, $1.8 billion will go to consumer relief, and the rest will go to settle other federal and state claims. Bank of America, Bank of New York Mellon, JP Morgan Chase, State Street, and Wells Fargo have until October 1st to get their act together and back to the feds because they all failed the living will test, which basically means during a potential financial crisis, their wind down would not be pretty and it would require more taxpayer money to bail them out. So maybe there will be even more fines levied later this year. Apparently, Generation X is still licking their wounds after the market meltdown. A Wall Street Journal report says Gen X is the hardest hit when it comes to home ownership. Home ownership is the highest among 65 and better at 79.3%, but 34 to 44 has the only age group with a slight bump in home ownership, but the Generation X still has some ways to go and was hit the hardest. Everyone is secretly hoping 2015 was the rock bottom of home ownership rates and that we can start increasing in 2016. Okay, data nerds, if you caught my radio show interview with Rob Hahn, you know that there's a big data war sort of going on between Realtor.com and Zillow. There's also other data wars going on, like for companies like CoreLogic and now RealtyTrack. RealtyTrack is launching a new data service and availability for an API, and will include data points like property status, property info, loan information, including loan amount, type, and interest rate. Automated value systems will be rolled in, as well as neighborhood data and more, even down to environmental and natural risk hazard, which is really interesting. So they are really backing down into the data business where we've all thought of them as strictly like foreclosure information nationwide. So really interesting. And this really sounds it sounds pretty impressive and more like a GIS system. With information that only commercial companies had access to. So I haven't checked out pricing yet, but it'll be interesting to see if this kind of information is available to real estate investors and realtors who are working more on a local level. Freddie Mac released its new MIMI report. The multi-indicator market index shows California is the 8th strongest market in the country. Pretty weird considering we've been getting all those overheated, overvalued market reports out in the last couple months. But the report looks at jobs, home buying activity, and mortgage data. California went up 3 spots last year, with Los Angeles and the Orange County market making the 5th spot and the Inland Empire landing at spot number 8. Huge turnaround from where we were probably just 5 or 6 years ago. Weakest states include Nevada, New Mexico, North Carolina, and Illinois. Our friend Christopher Thornburg with Beacon Economics has co-authored a report with the USC Lusk Center for Real Estate. The gist of the report: you've got 2 choices in California. You either build more residential, commercial, or you're going to see continued rent increases. Thornburg also says that wherever you're housed at 70, you're not going anywhere. I'll take it that means that you really don't have any other options, unless the Appleton Young said just as much at the last I Survive Real Estate. They're really not going to find anything cheaper, especially if they've been there for quite some time. Millennials are going to have to keep an eye out for boomers on where they go during retirement, because boomers are going to move. Hopefully they have the money to afford staying in California. But you tell me, where are boomers going? What are some of the trends as they're retiring? Are they upsizing? Are they downsizing? Are they moving out of state? Where will millennials go as they are looking to start to buy? If you're on YouTube, please leave a comment below and don't forget to like the video and subscribe to the channel so you don't miss a beat. If you're on Facebook, please don't forget to not only like the Norris Group page, but don't forget to add us to your See First list and with notifications on. Leave your comments below the video. And if we missed something, share the story on our comment sections on either YouTube or Facebook, and we'll make sure to include it on our blog at thenorrisgroup.com/blog. May 4th, we're back on the road doing Stay Put, Cash Out, or Change Seats. We'll be in the Inland Valley Association of Realtors, and this is the last time I have us scheduled for the Inland Empire area, so don't miss it if you're a realtor and in town. May 11th, we'll be doing it at the OCRE Forum. We actually haven't been there in the last few years. May 19th, the Apartment Owners Association's $1 Million Trade Show out in Long Beach. May 19th, we'll be doing Stay Put, Cash Out, or Change Seats in Pasadena at the Pasadena Phoebe, and then on the 26th in Phoebe, Long Beach. So hopefully we'll see you there. If you want to find out more information about events and our hard money loans, including fix and flip, buy and hold, and new construction starting at just 6.9%, check out thenorrisgroup.com. Or if you'd like more information on passive investing with trustees, check out tngtrustees.com. With that, have a fantastic tax day, and we'll see you next week.